852. This is dual purpose test, slide 1, take 1, and we'll go in 5, 4, 3, 2.
Hello, we're back with another video. In this video, we're going to talk about dual purpose tests. Dual purpose tests are one way auditors try to improve the efficiency of an audit. It usually saves time both for the auditor and the client because multiple tests are performed on the same sample, which means the client only has to provide one set of documents and the auditor only has to review one set of documents. Just a quick review. Your textbook identified 5 types of tests performed by auditors. We've already spent time discussing risk assessment procedures in earlier modules, and we talked about tests of controls during our discussion of how auditors assess control risk. What's new in this chapter are the last 3 types of tests, which are substantive tests of transactions, substantive analytical procedures, and tests of details of balances. These 3 types of tests are all used to look for monetary misstatements or actual dollar value errors in the financial records of a company. Since the focus of our discussion today is dual purpose tests, we're going to focus on how auditors complete tests of controls and substantive tests of transactions at the same time. Before we go any further, we need to clarify the difference between the purpose of a test of controls and a substantive test. When the auditor is testing controls, they're looking for evidence that the control was executed in accordance with the design of the control. For example, imagine a company has a control that requires the CFO to authorize all checks greater than $10,000. The auditor will select a sample of cash disbursements during the period under audit, and for all checks greater than $10,000 in their sample, they have to ensure that the CFO actually signed the check. Conversely, a substantive test is looking to ensure that the accounting records are accurate, regardless of whether or not the control was operating effectively. Using our example of the cash disbursements, to perform the substantive test, the auditor is going to look at supporting evidence, such as the purchase order, the receiving report, and the vendor invoice to ensure that the dollar value recorded in the cash disbursements journal agrees with the source documents. To give us a more concrete example, let's think about how the auditors would test the accuracy of sales. When testing sales, the starting point is the sales journal. Can I pause for a second? Can you keep going with the script for a second?
Sure.
I think that there's a mistake somewhere. Can you go through the script? Let me see the script. Just a second. What is going on? Okay. This is fine. I just made a mistake. Can you keep going through the script a little bit more?
Sure.
Okay, keep going. Okay, that's okay. We can go back to the start of this slide.
Okay, sounds good.
Sorry, I just was thrown off by something for a second, but it's fine. Everything's good. Okay. I'm going to grab some water real quick, too.
Yeah, sure, no problem.
Sorry. Okay. All right. We can start at the start of this slide.
All right. Ready?
Mm-hmm.
We are rolling. This is T853. This is dual purpose test. We're going to pick up at slide 5. Take 2, and we'll go in 5, 4, 3, 2.
To give us a more concrete example, let's think about how auditors would test the accuracy of sales. When testing sales, the starting point is a sales journal, which is the company's record of all sales transactions during the year. From that sales journal, the auditor would select a sample of invoices to test, and the auditor is concerned about how controls surrounding those invoices are generated and ensuring that the dollar values related to the invoices were recorded accurately. So imagine the auditor selected a sample of invoice from the sales journal, and this is one of those invoices. We'll consider the relevant controls first. In this example, the company uses a computer system. Sorry, I don't know what I've done. Let me look at something real quick on my computer.
Oh my God, too soon, too soon.
Do you have a problem in your vehicle?
Yeah. Well, it's gonna be out of action for 8 weeks.
Holy smokes.
Gotta make jokes to keep it lively. Is it just like different words or is it like?
No, it's not going to be different words.
Okay.
I just think that I missed. Yeah.
How many miles on your car now?
5,500. It's a car that's only 7 months old.
Whoa, dude.
Yeah.
That's nuts. But that should be warranted, isn't it?
It's in warranty and everything, but the part is back ordered.
Oh,
So
of
it's
course.
gonna take 8 weeks to get here and then 4 hours to put it in the car.
That's insane.
Yeah, I don't have a loaner yet.
That's
It's nuts.
What about your insurance?
I don't think my insurance covers it. Or they'll just like, I have Progressive, I think. Not sure if they cover our rental.
You should check, yeah, you should check with
Okay.
insurance.
Yeah, hopefully.
Do you guys share a car?
Yes, only one car, so.
Does your wife need it to
No,
go?
she works from home.
Yeah, that's alright. Well, that's good. But in the meantime, the dealership is even like, are they routing you through a dealership for the repair?
Yeah, yeah. That's what they don't have a loaner. They're like, oh yeah, Hyundais are apparently exploding right now. No, or and like their engines are blowing up. So a lot of people have their engines blown up, and I don't have any loaners. Loaner. How am I supposed to do it?
Um, keep keep receipts and documents of everything, because if it really is a widespread problem, maybe like a class action lawsuit. Like you're making some compensation later. But double check it.
Yeah. Yeah, they didn't charge us for towing or anything, but it's just a loaner thing. And they're like, oh yeah, you can rent a car, and then maybe we would put some money in.
So, I'm the same thing. Keep receipts for doing that too, because you might be able to build up something really quick with a full service. That could be relatively painless if it ends up like, depends on how long the rental is before the process is. But like if you end up spending like $2,000 renting a car and it costs you like $500 to become a quarterly, that's pretty quick. So, and you might be able to do that. But just keep like document everything, keep all the receipts, put it in a folder, so
Yeah.
you've got them all set aside. That really sucks, man.
And apparently cars have that issue. A lot of cars are having the same issue. So
Hearing buses having the same issue.
they heard the bus crash.
Okay, guys, sorry about that. I'm ready. Okay, back. You got that? Okay.
Is your car insured?
Double check your framing one last time. Alright, good. Did you update anything on there?
I did, but I refreshed
Okay,
it.
perfect, thank you. Alright, the slide behind you is blank.
That's what I want it to be.
Okay.
And I'm going to show something in just a second, but I'm going to start
Okay.
with it blank so it's not
Okay.
distracting.
Got it. Alright, We are rolling. This is T854. This is dual purpose test slide 5. This is going to be take 3. And we'll go in 5, 4, 3, 2.
To give us a more concrete example, let's think about how auditors would test the accuracy of sales. When testing sales, the starting point is the sales journal, which is the company's record of all sales transactions during the year. From that sales journal, the auditor would select a sample of invoices to test, and the auditor is concerned about controls surrounding how those invoices are generated and ensuring that the dollar values related to the invoices were recorded accurately. So imagine the auditor selected a sample of invoices from the sales journal, and this is one of those invoices. We'll consider the relevant controls first. In this example, the company uses a computer system where invoices are automatically generated based on the item number and the quantity sold. The computer system uses a database that stores prices to determine the appropriate prices to use on the invoice. The system then calculates the extended price using price times quantity to determine the dollar value sold for each item. And finally, the system creates a total sales amount for the invoice. These automated controls help prevent manual calculation or transfer errors. So the first control is that the prices on the invoice are automatically calculated from the master price list. The next control is that extended prices are automatically calculated as price times quantity for each line item, and the invoice total is automatically calculated as the sum of all extended amounts. So if the auditor wants to test these controls, they will verify that the correct prices were pulled from the master price list database and verify that the system properly multiplied price times quantity to determine the line totals and properly summed the invoice total. So that's the first part of our dual purpose test, the test of controls. But the value of dual purpose tests is that the auditor can use the exact same sample, the exact same documents to also perform substantive test work. So let's consider how the auditor may test the dollar values associated with this invoice. Remember, for substantive test work, the auditor wants to make sure that the accounting records of the company are accurate. We're focused on the accuracy of the dollar amounts. For just a minute, ignore everything we talked about related to controls and just think about the steps the auditor would need to perform in order to test the dollar value accuracy of the invoice. First, the auditor would need to ensure that the prices agree to the master price list, because if the prices are wrong, then the dollar value is wrong. Then the auditor would need to ensure that for each line item, the extended amount is properly calculated as price times quantity. Then the auditor would sum each of the extended amounts to ensure that the invoice total is correct. And finally, the auditor would need to agree the amount from the invoice to the sales journal to ensure that the invoice was properly recorded in the accounting records. Now, most of these steps sound very familiar because those are the exact same steps we just discussed as part of our test of controls. The only step that's new is tying the invoice to the sales journal. But we can get credit for both because this is a dual purpose test, and that's where the efficiency comes in. So that's what a dual purpose test might look like for an automated control, but let's consider a very similar situation where a manual control is used. This is a similar invoice, but this time imagine that the company does not have a computer system that automatically prepares the invoices. Instead, the invoice is manually prepared by a billing clerk. To make sure the invoice is correct, the company has a control that requires the billing manager to review all invoices before they are sent to the customers, and this review is indicated by the manager's signature as the control. During this review, the manager makes sure that the correct price was used and that the math was performed correctly. So it's a control related to the accuracy of sales, just like the automated control we considered earlier. So the control that the auditor would test is the manager's review. Remember, tests of controls must specifically test the controls that exist at a company. So the auditor has to first understand the design of the controls at the client. Then the auditor can determine how to test the operating effectiveness of the controls. For the substantive test of transaction in this example, the auditor would perform the exact same procedures they performed in the first example. The auditor would ensure that the prices agree to the master price list. They would verify the mathematical accuracy of the invoice, and they would agree the invoice to the sales journal. There's a little bit less efficiency gained in this example, but it's still much faster for the auditor to examine one sample invoices than two separate samples, one for controls and one for substantive tests. And the client's definitely happier when they only have to provide one set of documents instead of two. Now, in some circumstances, the auditor may design a sample that would be used for dual-purpose tests, as both a test of control and as a substantive test. The size of a sample designed for dual-purpose tests should be the larger of the two samples that otherwise would have been designed for the two separate purposes, but the auditor would still gain efficiencies by performing dual-purpose tests. We'll start talking about how auditors determine sample size soon, but that's something we'll cover in the future. Bye for now.
All right, and cut. That's good.
We good on that one, you think?
Yeah, we're good on that one. We can move on.
Okay.
The next one. You want to do the sales cycle flow chart next?
Sure, that works for me. Right, I'm ready whenever you guys are. Okay. I was just reminding myself what we're doing this one. And this one, you'll see, see how I want to be down in that box.
Oh,
Because that was one of the slides that is an option.
for this one, it looks odd if we shrink you down and you're like standing in your desk. We can take you off screen. That would be a better
Okay.
option.
Okay. So what do you want to, how does this work then?
So
I presumed it would be fine since this was one of the templates that was provided.
This was before when we built the masterclass studio, so that's what they would do. They would put in.
So what I think we can do here is because you're on separate channels, we can just record you normally, but then when we go to edit it, we'll just take you off screen.
Okay.
This one,
Okay.
and we can modify the image so it fits.
It'll
across
look
the
like
whole-
centered a little
it'll
bit.
it'll
Okay.
look
Should we
better.
do that on the slide? Though?
We could, yeah, if that makes it easier, we can go ahead and do that on the slide now.
I mean, there's a bunch of slides though.
But yeah, well, if we pull you off screen.
I don't think you're gonna
it's
want to do
fine.
that because it's gonna move all my. We'll try it and see. I have lots of different animations.
Okay.
I don't think you're gonna do that.
Okay.
I have animations that appear on all the slides as I walk through them.
Can we like control A and then just drag it to the middle? Let's see. Yeah, that looks a little bit, yeah, looks about right.
So all the animations come with it.
Okay, perfect.
Try to go
But
through it.
there's like 20 slides like that.
Yeah,
Okay.
It pulled the animations, good.
Yeah, we want to do that because doing that in post is just a lot
Okay.
more.
Well, do you want to do a different video right now then? And then, I mean, because I literally have 20 slides that are like this.
I think we can do it.
Okay, yeah, you can do it real fast. That's fine. Okay, great. Perfect. Sorry, I
you're okay.
presumed it would be fine.
You're okay, Bethany,
Yeah,
it's really, we can roll with this, it's okay.
This will just save there'll be some time in post.
Yeah, it'll take you like 5 minutes probably.
Yeah. And this is not the most complicated thing I've done before, right before a production, so don't worry about it.
Yeah.
I'm gonna go. Is there a place to fill my water bottle at?
Yeah, there is a water fountain if you just go down this way,
Go down
down the hallway. Yeah.
The next one also has the same thing.
Okay.
The cash flow chart one has the same. It's much shorter, but it has the same idea.
Okay. I don't think I have the right. The next one's the substantive analytical procedures example.
That's fine. And then there's another one that's called the cash. Called cash receipts cycle flow chart.
Oh.
That's the one that also has.
Are we doing that one today?
Yeah.
Okay.
It was on the list I sent to Chris. So we
Yeah.
should have 4 for today.
Okay. Cash receipts, transactions, flow charts.
This looks good, thank you.
Yeah, of course. Could keep going on this one. The other one's correct as well.
Okay.
The substem.
The substantive analytical procedure, it's like SAP, I think is the...
It doesn't have any content on it.
No, there was, for some reason, there's two folders. One called Substantive Analytical Procedures Example. That's not the one I'm using. There's one called SAP Gas Company Example, which is still, I don't know why there's two folders, but that's the one that's got stuff in it.
SAP Gas Company Example?
Mm-hmm.
Okay, perfect.
I was just talking to Chris earlier about how, like, the naming conventions for these folders is kind of complicated because, you know, you might change your mind about what you want to call something, but they're stuck with the titles.
They get generated right before.
And I don't know why in this case there was two folders. I was like, I don't know which one to use because I've only ever had one that I was planning on doing. So I was like, I'll just whatever. Okay.
My wife keeps talking about SAP all the time.
Yeah. SAP is is the name of a program too, so it gets a little confusing. Oh, so I'll do it in slideshow. So you won't see me once we get to this.
Yeah.
Oh no, this is the wrong slide deck. This was the original slide deck. Yeah. Sorry, we're done with that one. For this one.
Yeah. So what he'll do, he'll just cut to the full screen.
Okay.
For that.
Gotcha.
But you'll still see yourself on the confidence monitor here, but that's just because that's the output that we have. So
sure.
We have this.
But I just won't even be here at all. Whatever direction has gone is okay. So I just don't need to worry about what I look like or my hand. I can do anything I want with my hands on these slides. Okay. I can finally be big, right?
All right. All right, ready?
Yeah, can we make the font just a little smaller on the display? That's good.
All right, ready?
Yeah.
Okay, we are rolling. This is T855. This is sales cycle flowchart, slide 1. It's going to be take 1 and we'll go in 5, 4, 3, 2.
Hello, we're back with another video. Today, we're going to talk about the key activities and documents in the sales cycle. In your textbook, you read about the 5 key activities in the sales cycle. In this video, we're going to look at a flowchart that represents the first 4 of these activities and the related documents a company would create as a transaction is processed through the cycle. The 5th step, cash collections, is really a separate set of activities, so we'll have another video that walks through a flowchart for that step. I have here a flowchart that represents the sales cycle for a typical manufacturing company. Before we jump into activities and documents, let's take a minute to get oriented. You'll notice that there are 5 departments involved in this process, which are listed across the top of the flowchart. They are the customer order department, the credit department, inventory control, billing, shipping, and billing. Each of these departments is represented in a different swim lane so the user knows what tasks are completed by each department. You'll also notice that this flowchart uses a lot of on-page connectors, which are the circles. Just a quick example, we can see that 2 copies of the sales order document move from the customer order department to the credit department, which is shown with these circles. Finally, it looks like the company shown in this flowchart has a pretty manual process. We can see lots of documents being generated and moving between different departments. And we can see that individuals are performing key activities like comparing 2 sets of documents. Key actions are represented by this rhombus shape. Now that we have the general layout of the flowchart, let's look at the key steps and related documents. The first step in the sales cycle is entering an order from a customer into the vendor's sales system, and that takes place in the customer order department. Now, an important document that's not displayed in this flowchart is the customer's purchase order. As you learned in your systems class, a customer prepares a purchase order, then sends that purchase order to the vendor to initiate a transaction. What we're showing here is the vendor side of the transaction, so the receipt of that PO is kind of wrapped up in the Take Customer Order box, which is the first box in the flowchart. But there are other ways that the customer order department could receive an order, like if the customer calls the company to place an order. Here's an example of a customer purchase order, and this relates to a transaction that we'll be following throughout this video. The customer is Aranda Renovation and Repair, and they would like to order some building materials from a vendor named Builders Supply. Aranda's purchasing agent would have reached out to the vendor and discussed the pricing and terms. Then the PO would get approved, probably by the purchasing manager. Then the PO would be sent to the vendor. Once the PO is received by the vendor, it will start the sales transaction cycle for the vendor. So let's flip back to our flowchart and keep working through it. We're still in the first swim lane on our flowchart, and we now want to consider the sales order that's prepared by the vendor. A sales order is a document that provides the details of an order and the terms of the transaction. It's created by the seller after a buyer submits a purchase order. Or if a purchase order is not involved in the sale, the seller creates the sales order after the customer agrees to purchase a product. An order document typically includes the customer information, product details, pricing, and delivery information. Let's look at an example of a sales order. Here's the sales order that Builders Supply prepared after they received the purchase order from Aranda. Generally speaking, a sales order will include the vendor's name and address, the contact info of the buyer, the order date, shipping or delivery date, product information, prices, taxes, and fees, and any other applicable terms and conditions or relevant information. You may be wondering what's the difference between a sales order and a purchase order. While both documents contain similar information, there is a really big difference. A sales order is an internal document for record keeping and order fulfillment purposes. It's created by the vendor and it's only used by the vendor. It's never sent to the customer. A purchase order, on the other hand, is a legally binding document issued by the buyer to the seller indicating an intent to purchase goods. A customer creates a purchase order and sends it to the seller, who then creates a sales order based on the purchase order details. So that's the end of the first step, sales order entry. Let's move to the next step in the cycle. The next step of the sales cycle is credit authorization. No new documents are created during this step, but some really important activities are being performed. First, it's important to note that the credit department is separate from the customer order department. The sales representatives, who are part of the customer order department, likely have an incentive to sell as much as possible, especially if they're paid based on a commission. So it's not appropriate for them to approve credit for customers. The risk is that a sales rep may sell to a customer who isn't likely to pay for the goods because the sale would help the sales rep meet sales goals for the period or receive a higher pay. So it's important that a department separate from the sales department should be responsible for authorizing credit. To authorize credit, the credit manager would look at the total dollar value of the sales order and the customer's current AR balance, which is recorded in the AR subledger. And if the total of those two values is less than the customer's credit limit, the transaction would be approved. In many companies, this is performed automatically by the system, and only exceptions are reviewed by the credit manager. But in this case, it looks like all transactions are routed through the credit manager. If the transaction is approved, then the sales order is sent to the inventory control department. So while we don't have an entirely new document in this step, we do have a modification to a document. In this case, we're back to our sales order document, but now it's been approved by the credit manager because there's a department stamp and signature. This transaction is now ready for the next step. The third step of this sales cycle is the shipment of goods, and this is shown in two swim lanes on our flowchart. First, the inventory control department pulls the goods from the warehouse, then the shipping department prepares the goods for shipment. On this flowchart, the document that's prepared by the shipping department is called the shipping document, but you'll find that most companies create two documents at this step. A bill of lading, also known as a BOL, is a legal document that serves as proof that the seller has handed over goods to the shipping carrier for transport. It functions as a contract between the shipper, the person sending the goods, and the carrier, as well as a receipt. The BOL is a legal binding agreement that details the shipper's and carrier's responsibilities throughout the shipping process. However, the BOL does not list out the items in the shipment. Instead, it usually includes information such as the number of pallets, the weight of the pallets, or other information to identify the shipment. In contrast, the packing slip primarily serves as an internal document for inventory management purposes, and it does not have any legal implications. The packing slip lists the physical contents of a shipment, like the product names, the SKUs, the quantities, and other order-related details. It helps confirm that the order was packed correctly. Often a copy of the packing slip is included with the shipment so the buyer can identify the order when the goods are received. Let's look at both a bill of lading and a packing slip. First, here's an example of a packing slip. In some ways, it's similar to an invoice in that it records the purchaser and a list of goods in the order, but it doesn't include any pricing information. Instead, it includes information that would be useful for inventory control purposes, like the weight of the products and the number of pallets in the shipment. Next, here's the bill of lading for the transaction that we are following. A few important things to note on the bill of lading. First, the shipping terms are noted here. This information may also be on other documents, but the auditor would definitely want to know when ownership of the goods transferred to the purchaser because that's the date when revenue should be recognized. So, because the goods were shipped on January 2nd, and oh dear, something got messed up with my animations. So we're going to need to start over at the beginning of this slide.
Okay, sounds good.
I'm going to fix them on this real quick. Okay. We can start at the beginning of slide 13.
All right. Ready to go?
Yep.
We are rolling. This is T856. This is sales cycle flowchart. We're going to start at slide 13. This is take 2, and we'll go in 5, 4, 3, 2.
Next, here's the bill of lading for the transaction we are following. A few important things to note on the bill of lading. First, the shipping terms are noted here. This information may also be on other documents, but the auditor will definitely want to know when ownership of the goods transferred to the purchaser, because that's the date when revenue should be recognized. So, because the goods were shipped on January 2nd and the shipping terms were FOB shipping point, revenue should be recognized on January 2nd. If the shipping terms had been FOB destination, revenue would not be recognized until the goods were received by the purchaser. From the seller's perspective, it's much easier to know when the goods left their warehouse than it is to know when the goods were received by the purchaser, so most vendors prefer FOB shipping point. The next item of note on this bill of lading is the signature of the shipper. This is an employee of the carrier who is on site at the vendor's warehouse and picks up the goods for shipment. This individual does not work for the vendor, so the auditor uses this as external evidence that the goods were actually shipped. If you are trying to obtain audit evidence that shipment actually occurred, a bill of lading is much stronger evidence because it is an external evidence compared with a packing slip, which is internal evidence, a document that was generated by the vendor and could be fabricated. However, a bill of lading alone doesn't prove without a doubt that the goods were shipped because the employee of the shipping company doesn't open all the pallets and double check that the correct items were included in the shipment or that the correct quantities were included. So typically, the auditor uses the packing slip and the bill of lading together as evidence that a shipment occurred. Now, going back to our flowchart, let's presume that the company is using the term shipping document to refer to a document that's a combination of a packing slip and a bill of lading, even though that's not typically done. One copy of the shipping document goes to the customer because it would be included in the shipment, and one copy goes to the billing department, and one copy is filed away with the shipping department. Now we're going to follow the copy of the shipping document that's sent to the billing department for the next step of the sales cycle. Now we're ready to discuss the fourth step in the sales cycle, which is billing customers and recording sales. If you stop and think about it, nothing that's happened so far has been recorded in the financial records of the company. Several documents have been created, like the sales order and the packing slip, but these documents don't trigger any journal entries. They're used for internal record-keeping purposes, but they haven't impacted the journals and ledgers. It's not until the billing step that financial transactions are recorded. We see that the billing department has a copy of the sales order that they originally received from the customer order department and the shipping document and sales order that they received from the shipping department. Note that the second copy of the sales order is the version that includes approval by the credit department. Now that the billing department has all of these documents, they know that the order was approved by the credit manager and the goods were shipped. So, since the shipping terms were FOB shipping point, it's time to generate an invoice and record the sale. Here's the invoice for the transaction we've been looking at. Because the order was fulfilled in total, all the quantities match the original purchase order that was received from the customer and the sales order that was prepared by the sales department. Now that the invoice has been prepared, the next part of the billing and recording step is to actually record the transaction in the books. On this flowchart, this is represented by the box that says "to accounting." Even though we don't have the activities of the accounting department on this flowchart, let's think about what will happen next. First, the transaction will be recorded in the sales journal. The sales journal is a special journal that is used to record all credit sales transactions. As you might remember from your systems class, the purpose of special journals is to remove high volume transactions from the general ledger and instead record similar transactions together. Then at the end of each reporting period, the total from the sales journal is posted to the general ledger. It's much more efficient than posting each individual sales transaction to the general ledger. Here's an example of what a sales journal might look like. This is just a portion of the month, but we can see the sale to Aranda Renovation and Repair that we've been tracking. At the end of the month, or at any interval selected by the company, they can do it weekly, daily, it doesn't matter, the total from the sales journal would be posted to the general ledger. Another document that needs to be updated when a sale is recorded is the accounts receivable subledger. Sometimes this is called the AR master file or the AR subsidiary ledger. The terms are interchangeable. The AR subledger tracks individual customer transactions, payments, and balances. Unlike the general ledger, which only records total accounts receivable, the AR subledger breaks down this information by individual customer accounts. This allows businesses to monitor outstanding payments, track customer payment behavior, and manage collection efforts. And remember, back in step 2, the credit manager used the balance from the AR subledger when they were approving credit. It's very important to update the AR subledger timely so the credit manager knows the current outstanding balance when making credit decisions. This is just an excerpt from the AR subledger showing the customer we've been following, including their purchase of goods on January 2nd. There would be a record like this for each of the vendor's customers, and the total of all the customers from the AR subledger should always agree to the total AR balance in the general ledger. The last document I want to look at is the monthly statement sent to customers. I have the statement that Builders Supply sent to Aranda at the end of January. It looks like Aranda made another purchase later in the month, but they haven't made any payments during the month of January. This is not necessarily a problem because the first of these invoices was dated January 2nd, and the payment terms said that payment wasn't due until 30 days later, so Aranda isn't late yet in paying. But a monthly statement is a good way to remind customers to make payments. Also, if the customer identified any errors in the monthly statement related to the occurrence or accuracy of sales, They would inform the vendor of the error, and the vendor could correct their records. That was a lot, but I hope it helped you better understand the flow of activities and documents in the sales cycle. From now on, you'll be expected to know what each of these documents is used for, who typically prepares the documents, and how the documents would be used by the auditor to obtain audit evidence.
All right, and cut. That was good.
Which one do you want to do next?
We'll do the substantive analytical procedures.
Okay. Got it. Okay.
I just need to check focus real quick. Sometimes the monitor kind of gets fuzzy.
All right, ready?
Yep.
We are rolling. This is T857. This is substantive analytical procedures example. We're going to start at slide 1. This is take 1, and we'll go in 5, 4, 3, 2.
Hello, we're back with another video. Today we're going to look at an example of a substantive analytical procedure for testing accounts receivable. One of the ways auditors can test the accounts receivable balance is substantive analytical procedures. Analytical procedures can be used as a substantive test when we are auditing a predictable area that can be precisely estimated. You might be wondering how this could be applicable for accounts receivable. For some companies, a substantive analytical procedure for accounts receivable would not make sense because the AR balances fluctuate significantly during the year. However, for other companies, accounts receivable are very stable and are based on known variables. Let's walk through an example of this. Imagine you're the auditor for an electric company in the state of Georgia. Let's just call the company Georgia Electric. They have a December 31st year end, and the AR balance as of the end of the year is $1.25 million. Your textbook says that confirming account, you know what? I just realized I made a mistake on my slides. Can you give me just 2 minutes here? Sorry.
No worries.
I changed something and forgot to update it in all places.
Is it just this slide or is it this slides before?
No, it's just going to be it's going to be just this slide. Yeah. Okay. Sorry guys, I'm gonna.
No worries, take your time, but don't just into the bathroom.
Okay, perfect. Well, I've updated. I think I'll flip through just to make sure I got it in all places, but I realized I changed a number and didn't change it everywhere, which is bad because that would make it be pretty inconsistent.
Bethany, you're an accountant. You're not supposed to do that.
Man, but when you make up numbers for an example, it's hard to always get them right.
I'm due there.
We make up numbers to force them to work, especially.
We're chuckling in here.
Okay.
All right, ready? We're going to start at slide 4.
Okay.
All right, we are rolling. This is T858. This is going to be SAP example. Take 2. We're going to start at slide 4, and we'll go in 5, 4, 3, 2.
Imagine you're the auditor for an electric company in the state of Georgia. Let's just call the company Georgia Electric. They have a December 31st year end, and the AR balance as of the end of the year is about $1.2 million. Your textbook says that confirming accounts receivable is the standard audit procedure to test existence of AR. But for this company, do you think it would make sense to send AR confirmations to their customers? If you received an AR confirmation in the mail from your electricity provider, would you have any idea how to figure out how much you owed them on a given date? Probably not. So confirming AR is not a good idea. However, accounts receivable should be relatively predictable for a couple of reasons, so performing a substantive analytic could be a great audit procedure here. Let's think about why AR is predictable for Georgia Electric. First, they know exactly how many customers they're serving at a given time because the homes and businesses have to create an account before they will connect power to the building. The auditor could get a report from the company with a customer count by month, probably even by day. Second, they know exactly how much they charge customers. In the state of Georgia, electric rates are set in advance and can only change with approval from a state commission. So the auditor could easily verify the billing rate based on the most recent approval from the commission. Now, while we know the number of customers and the billing rate, there's another key variable that needs to be considered, and that's how much energy customers actually use, which can fluctuate significantly based on the weather. In Georgia, people use a lot more power in December than, say, October because they're heating their homes. Consumption is very dependent on weather. But the electric company closely monitors actual energy consumption because they need the electricity generated by the power plants to match the electricity used by customers, or else there would be blackouts. So let's presume that the auditor has access to reports that summarize the average electricity usage by customer. For our example, imagine the auditor reviewed the relevant reports and identified some key facts. Customers have increased by 10% in both November and December compared to the prior year. The average usage was 5% lower in November due to warmer than average weather, but 10% higher in December due to colder weather. And finally, the billing rate is 25% lower than the prior year. Now that we have these facts, let's consider how we would build a substantive analytic. In order to build our substantive analytic, the first thing we need to do is identify relevant figures from the prior year. I have summarized here the 2 months that we're looking at, the number of customers by month, the average usage by month, and the billing rate. All of this information was audited in the prior year, so it's a reasonable basis to use this information as the starting point for our calculation of the expected AR balance for the current year. Now, why are we only looking at November and December? Electricity customers generally have a grace period of about 2 months after a bill's due date before service is disconnected. So the vast majority of customers are very good about paying within 60 days. So we want to narrow our analysis to just consider balances that would reasonably be considered an AR as of year end. The last key fact that is from the prior year that's relevant is the calculated AR turnover for the year, which was 45 days. So while customers have about 60 days before their power would be cut off, on average they're paying around 45 days. Now that we have our prior year information, let's pull the same information from the reports for the current year and calculate our expected AR balance. Here's a summary of the information the auditor could gather from reports provided by the company for the current year. Again, we have the number of customers by month, and there's a slight increase month over month. We have the usage rate, which the auditor noted is down for November but up for December in comparison to the prior year. And the auditor ensured that these changes were reasonable based on weather. And finally, we have the billing rate, which is a decrease, which is a great deal for the customers. Using these inputs, the auditor calculates the revenue for the months of November and December, And maybe this would actually be useful for auditing revenue, but we're trying to test accounts receivable. Remember, the auditor calculated that in the prior year, receivables were outstanding for an average of 45 days. And we want to use that figure to estimate the portion of revenue that would still be outstanding as of December 31st. And that becomes our expected AR balance of $1.1 million. In order to use this analytic as substantive test work, we need to compare our expectation, the calculated number, to the actual AR balance as of the end of the year, which is $1.2 million. There's definitely a difference between our expectation and the actual AR balance, so we need to calculate the difference. Once we know the difference, the next step is to compare the difference to materiality. If, say, materiality was $75,000, this difference of only $36,000 would be immaterial, and the auditor would conclude that this analytic provides evidence for the ending AR balance. If, however, materiality was just $25,000, this would not be sufficient. In that case, the auditor could go back and revise the analytic. Maybe the auditor asks the client and learns that there's another factor that they didn't properly account for in the analytic. But if the difference doesn't get below materiality, then the analytic doesn't provide support for the ending AR balance. Just as a quick side note, there are some specific rules that auditors need to follow before using analytical procedures like this as a substantive evidence. But we're not going to cover those rules. I just wanted to give you a general feel for what a substantive analytical procedure for an AR balance might look like and help you understand why analyticals are sometimes better evidence than confirmations. That was a really quick run through of a substantive analytical procedure. In the real world, sometimes SAPs really are this easy, but sometimes they can be incredibly complicated. If, however, there is a predictable relationship, no matter how complicated, and the auditor is able to develop an effective substantive analytical procedure, it can dramatically reduce the other substantive test work necessary for an account balance. And even if the substantive analytic takes a little while to work through, it will probably take significantly less time than selecting a sample of transactions and vouching those transactions to supporting documentation or sending confirmations. Again, a substantive analytical procedure uses predictable relationships among financial and non-financial data to calculate an estimate of an account balance. Financial data would be things like the billing rate in our example. Non-financial data would be things like the number of customers and the average electricity usage. These non-financial elements are often critical to a successful analytic. And again, the reason we do this is to reduce other substantive test work, thereby increasing the efficiency of the audit, and hopefully allowing us to finish work a little early and go home at a reasonable time.
All right, and cut. That was good.
Okay, so I think we just have one more, which is
The
cash receipts one. Yeah. Okay. I'll pull this one up.
I'm just getting the script ready. All right, we're ready.
All right.
All right, ready?
Yes.
We are rolling. This is T859. This is cash receipt transaction flowchart. We're going to start at slide 1. This is take 1, and we'll go in 5, 4, 3, 2.
Welcome back. Now that we've walked through a sales transaction and the related documents, we are going to follow the same transaction as it becomes a cash receipt. We know there are 5 key activities in the sales cycle. In the previous video, we looked at a flowchart that represented the first 4 of these activities, and in this video, we'll look at the 5th step, cash collections. We will continue to follow the purchase of materials by Aranda Renovation and Repair, the buyer or purchaser, from Building Supply, the vendor or seller. Here's the flowchart we're going to follow. This flowchart only has 2 swim lanes, the mailroom and the cash receipts department. And these 2 departments together represent the 5th step of the sales cycle, which is the processing and recording of cash receipts. Let's walk through this flowchart and look at some of the documents that are used. The trigger or start of this process is the receipt of a check and remittance advice in the mailroom. Both of these documents come from the purchaser. I think most of you know what a check looks like, so we won't spend any time talking about checks, but we do need to talk about the remittance advice. A remittance advice is a document that accompanies a payment and is sent by a customer to a vendor to specify which invoice the payment covers. This helps the vendor reconcile their accounts and properly apply the payment. This is particularly important when multiple invoices are paid at once. While it's not mandatory to send a remittance advice, it is considered best practice in many industries, especially for larger transactions or when payments are made in bulk. On this remittance advice, we can see that Aranda is paying 2 invoices, invoice 15541, which we looked at in our previous video, and invoice 15879, which was dated January 27th. So the total on this check is $22,484. The vendor will use this remittance advice to make sure they apply the payment to the correct invoices. Back to the flowchart. Once the mailroom receives the check and remittance advice, the first thing the mail clerk does is to restrictively endorse the check and prepare the list of receipts. Let's pause for a minute and clarify what it means to restrictively endorse the checks. Restrictively endorsing a check means placing specific instructions on the back of the check that limit its use or transfer. This is done to ensure that the check can only be cashed or deposited under certain conditions. Restrictions could be something like for deposit only or pay to the order of the certain company, followed by the payee's signature. This type of endorsement is commonly used to prevent unauthorized use of the check, reducing the risk of theft. Many companies endorse checks using a stamp containing the restriction. After endorsing the checks, the mail clerk prepares a list of receipts. The list of cash receipts might look something like this. It's a list of all checks received in the mail that day and the total dollar value of those checks. One thing to note here, it looks like Builder Supply has 2 people working together in the mailroom. This is an important control to reduce the risk of theft. It's much harder to steal a check when someone else is watching. As we follow our flowchart, we see that 1 copy of the list of receipts and all the remittance advices are sent to the accounts receivable department. The AR department will use the remittance advices to post the payments to the customer accounts and make sure the payments are applied to the correct invoices. This will update the AR subledger so the customer's current outstanding balances are reduced by the amount of their payments. A separate copy of the list of receipts and all of the checks are sent to the cash receipts department, which is then responsible for actually depositing the checks at the bank. Let's follow those documents. Well, let's look at the cash receipts swim lane of our flowchart. Once the cash receipts department receives a copy of the list of receipts and all the checks, they get the checks ready for deposit and prepare something called the cash receipts journal, or in this case, they're calling it the cash summary. The cash receipts journal is a specialized journal that tracks all cash received by a business. It helps organize and monitor cash inflows from various sources such as cash sales and customer payments. For the day we're looking at, the cash receipts journal includes 4 transactions from the cash receipts log, but also includes some sales that resulted in cash payments. Maybe Builder Supply has a small retail space where contractors can come pick up items they need at the last minute. So it includes both cash sales and credit sales. It's just whatever cash or checks were received on that day. The total on the cash receipts journal should agree with the deposit that is taken to the bank that day. Let's quickly wrap up our review of this flowchart. We see that the checks and the deposit slip are taken to the bank for deposit. A copy of the cash receipts log is sent to the accounting department. And a copy of the cash receipts log and list of receipts are filed away in the cash receipts department for record-keeping purposes. So that's the primary activities and documents in the cash receipts step of the sales cycle. The main purpose of this video is just to make sure you understand the contents of all these documents. Now that you're familiar with the documents, the next step is to think about how the documents are used for audit purposes. For example, think about how an auditor may use one of these documents to select a sample of transactions for test work, then another type of document to substantiate the transactions. That's all for today.
All right, and cut. That was good.